Hi, everyone. Thanks for joining and welcome back to Wall Street Silver. Our guest today is my good friend Mike McGlone, Senior Commodity Strategist at Bloomberg Intelligence. Welcome back, sir.
Thanks, Simon. It's good to be back.
Yeah, it's great to have you on. Every time you come down, like I say before, it's always a breath of fresh air having you come down to Wall Street Silver. I wanted to get you on to talk about everything that's happening in the commodities market and even more. Let's start off with gold and silver. A lot of people, if you were to say to them last year, gold wouldn't be where like 2,500, right? At this very moment. What do you see happening with gold from now for the next 6 months, Mike?
Don't know exactly the next 6 months. I think it's a matter of time it gets to 3,000. I think the biggest risk to gold is some kind of unexpected significant detente from President Z, who's really kind of tilted the world towards his axis of bad guys. Um, and a correction in the stock market, which would only be short term, I think, for gold. Big picture, gold's on a pretty solid uptrend. I think it's a matter of time it gets to 3,000. Um, and you just have to look for bumps in the road. Its biggest issue is it's a bull market and it's getting a little overbought. That's fine. I mean, people want to trade that, fine, but I'm looking for the big picture just to continue to advance. And I think what's happening, as you're seeing, is what's happening with all the other commodities, and silver's kind of in that bucket of industrial metals, copper, and they're all suffering with China. So it's
Yeah.
basically in commodities right now, it's gold versus everything. I love to look at the gold and silver ratio. I mean, it was basically you can go back hundreds of years with that right now. And it's basically 89, about 90 ounces of silver per 1 ounce of gold. Trends up. I don't
Yeah,
see what
yeah,
stops that.
100%.
I don't see what stops that, particularly if U.S. unemployment's just starting to turn higher. Volatility in the stock market's just starting to roll over. Chinese government bond yields are declining. And just look at the U.S. inverted yield curve. It's been inverted for as long as ever. It's still significantly inverted. So if you look from T-bills down to the 30-year, it's just starting to disinvert. Those are usually pretty good signs for gold and pretty bad signs for stock market and risk assets. And silver's more in that risk asset. And most commodities are more risk assets.
Absolutely. What other commodities are you looking at right now that is giving you like a kind of an indicator for the economy other than silver and gold? Like, are you looking at copper or what other commodities, Mike?
Well, definitely the base metals, the industrial
Yeah.
metals. The Bloomberg, let's see, how are we doing this year? The Bloomberg base metals, industrial metals index on a 1 year basis is down like 3%. I mean, that's not good.
Yeah, you're
And at the same
right.
time, gold on a 1 year basis is up 30%. So the
Right.
key thing is copper. Copper, Dr. Copper, I think, is on the cusp of a decent, significant breakdown following.
There's about $15 trillion worth of physical gold in the world sitting there costing money rather than being used is just absolutely insane. Monetary Metals is bringing gold back into the financial world, putting gold to productive use right now. The problem with gold, of course, in physical form is that it's heavy, it's cumbersome, it's not particularly easy to ship, and it costs money to store in a protected manner. This platform Monetary Metals created is a proven concept and allows gold to be put to productive use. So instead of sitting there costing you money, it's actually in use earning you money.
Learn how you can earn 2 to 5% in our leasing program and how accredited investors can earn up to 12% on silver paid in silver. This advertisement is not investment or financial advice. Minimum investment applies.
U.S. natural gas, following the grains, following bond yields in China, following U.S. unemployment rate going up, bond yields in China going down. And it's key thing is you're looking at shorter term as we record right now on September 9th is I'm just doing my latest commitment to traders data. Is copper still very long from a
Yeah.
speculative future standpoint. The only other commodity that's about as long as gold. Now gold has more enduring reasons to be bullish and long. We certainly have people like China and central banks behind that. But copper to me right now is just more speculative, excessive, and it's just a matter of time it breaks down. So put numbers on it. Copper right now is just about $4.07 a pound. I think it's more likely to go three. That's not profound on a normal basis, just going back 10 years.
Right.
It's a very highly correlated, highly autocorrelated commodity. The thing that's what's happened with copper this year is very similar to what Bitcoin did. Copper made a new high up to $5.20 a pound on the back of pretty substantial speculative excesses in futures. I mean, total specs got to almost 30, a third of total open interest on the LME and CME futures. That's a lot.
Yeah.
And to put that in context, the last few bottoms, big bottoms in copper, those total specs got to 5% short. And right now they're still 20% long. So overall, the big picture is copper specs are still very long. Bond yields in China, US are tilting lower. And I'll end with this. One thing I love to do with dollar price of copper is if you put it on the same scale as the US 10-year note yield, it's very close oftentimes. The 10-year note yield right now, 3.7%, implies the price of copper should be closer to 3.7. And then you look at 10-year note bond yields in China, 2.14. There's where we're going. What changes that? I don't know. To me, that's the whole global tilt. And the biggest risk, I'll end with this, the biggest risk to copper and all risk assets is a continued reversion in the US stock market. It's not a bear market, it's just reverting a significant overbought bull market.
Yeah, you absolutely nailed it. I agree with you there, Mike. It's such a huge pleasure having you come down to Wall Street Silver. Where can people connect with you? I'll put your links in the description below so people can connect with you as well.
At Twitter at Mike McGlone 11 and LinkedIn, Mike McGlone, Senior Commodity Strategist, Bloomberg Intelligence, and on your show. So
Yeah.
happy to hook up and put people on my distribution list if they ask.
Awesome. Well, yeah, such a huge pleasure having you come down to Wall Street Silver. And as the weeks and the months develop, we're obviously watching the Federal Reserve very closely. Before you go, when do you think they're going to be doing the rate cut, or what do you think is going to happen there? They're going to hold?
Well, they're going to cut. It's just a question between 25 and 50.
Right.
And I'm kind of on the fence which one they're going to do. I think what's going to happen in the next elongated period is there's going to be a decent cat and mouse game between the stock market going down, just reverting. I mean, it's 2 times GDP.
Right.
And the Fed just kind of catching up because their inflation metrics are still a little bit high, and everybody points out strong. Everything's tilting lower, certainly on a global basis, but the U.S. stock market, U.S. economy is not doing so bad. It's just everything. All my indicators are very bearish. I'm very downward, very recessionary, certainly from a commodity standpoint. So let's say they cut 25. But the thing is, the market's already cut for them. I mean, mortgage rates are down about 100 basis points in the last year. That's the 30-year mortgage. 10-year note yields maybe down 50 to 60 basis points on a year-over-year basis. Market's already starting to do that, and it's the long rates that matter a lot. But no, the Fed's right now is just catching up. I think they're going to do a cutting schedule akin to Greenspan's hiking cycle in 1994, which was basically 25 basis points a meeting.
Right.
And then it's the bottom line to me is, I'll end with this, is in 2009, which was kind of, the end of the financial crisis and when Bitcoin was launched, a 10% stock market correction in the US was dollar value about 10% of GDP.
Right.
Now, a 10% stock market correction, just normal, is 20% of US GDP. That's the most in about 100 years. Yeah. So how can anything else matter?
Yeah,
to me, that's the bottom line, is the U.S. stock market has to stay elevated or all risk assets go down. And I think the risk is that risk assets continue just to revert lower.
Yeah, absolutely. Well, Mike, again, such a huge pleasure having you come down to Wall Street Silver. As the market develops, as always, would love to have you back on.
Thanks for having me.
Awesome. Talk to you soon.